Hello, my name is Jack Elder, Senior Director for Advanced Planning for Comprehensive Brokerage Services. Today, I'm going to talk about something that has annoyed me ever since I've been in financial services, and it's the concept of self-insurance with respect to long-term care. So let's talk about it. And I think it helps to view long-term care, any financial planning scenario through the lens of a client. So let's do that. Meet Brenda Jones. She's 60, lives in Minnesota. She just recently helped her parents get through, unfortunately, challenges from coordinated care perspective. So she's wondering, should she get long-term care? I mean, there's a lot of noise out there. She doesn't know what factors to consider. And she's come across this idea that she could self-insure. So let's look at the question she has. Self-paying versus self-insurance. Is there a difference? What is the difference? And then whether or not the non-financial and the financial reasons for long-term care are worthy bet for her. So let's just take, first of all, the idea of self-insurance. Self-insurance is a myth. The whole idea of insurance is risk sharing. So if I am going to have a long-term care event, I'm not going to pool my risk with other people. I'm just going to take my assets from my assets under management to pay for my long-term care. That's not self-insurance, because risk is not being shared. Instead, I'm self-paying. That's the more accurate statement. Now, I don't think it's worth getting caught up in words, and I hope you're not taking this as me getting caught up in words, self-insurance versus self-paying. But I think conceptually, it makes a difference for clients. I mean, think about it. If you're self-paying, it means that your long-term care expenses will be paid from distributions from your financial assets, that you bear the full risk of those costs with the widest range of potential spending outcomes. So that is not pooling risk. That is you saying, you know what? I'll just chance it. Let's look at it from another perspective, self-paying versus de-risking. When it comes to our homes, there's a 1 in 90 chance of having to make a claim against your homeowners in any given 20-year period. Well, retirement is also about 20 years, and there's a 7 in 10 chance of an LTC event in your golden years. Why is everyone perfectly comfortable insuring a risk that has a 1 in 90 chance of occurring, but people are, think that they should keep the risk if there's a 7 in 10 chance of that risk occurring? I believe the reason why this, and it doesn't make sense, but I believe the reason why we have this kind of mismatch on risks and that you should insure versus maybe risks you wouldn't, which, by the way, you should insure both of these risks, is because advisors and clients and sometimes commentators are viewing LTC strictly as a financial decision, and they're using incorrect math. The rest of this presentation, the next few minutes, I'm going to correct the math using asset-based long-term care insurance. So let's jump into it using a one-pager that we provide with every long-term care quote. And every time I say long-term care, I don't mean traditional, I mean asset-based long-term care. This one-pager demonstrates the difference in the long-term care insurance leverage versus self-paying. And it provides a recognized cost of care forecast so the client understands the risk they're trying to insure against. So let's jump into it again with Brenda. I said at the top, she's 60. Let's assume that she's got $100,000 that she could use for long-term care expenses. She's a Minnesota resident. And importantly, since she's just been through it with her parents, she doesn't want to be a burden to her kids. This is the one pager that we provide with every quote. So let's say she's got that $100,000 and it's earmarked for long-term care expenses. If you forecast that long-term care event out into the future, in this case, we have it at age 85, but this could be age 80, 87, 82, whatever age you tell us to use, we'll be happy to use in this for this comparison. So in 25 years, that $100,000 would have grown, depending on her rate of return to anywhere between $255,000 to $405,000. Each of these return scenarios are net of fees and taxes. So pure rate of return, 6%. If she saves her money, she'd have $404,000. If she'd taken the same $100,000, allocated it to a long-term care insurance product, then she'd have $568,000 of tax-free of long-term care insurance in her pool. This is true. You pooling the risk. That 568, that 570,000, it's just flat out more than that 404,000. In fact, her 100,000 would have to earn 7.2% year after year after year, net of fees and taxes. How many clients age 60 and up can count on earning 7.2? How many advisors would show a portfolio projected to earn 7.2 in retirement? Not many. So it's a good rate of return. This is the proper math that should be analyzed when asking whether or not long-term care makes sense for a client. And by the way, it should be pointed out that the returns are guaranteed. The life insurance company bears 100% of the performance risk, so your client doesn't have to. And in this case, that 568,000 is broken down into approximately $103,000 of guaranteed protection per year. Well, that's good because, like I said, she's a Minnesota resident. If you take the current cost of care in Minnesota, you compound it at 3% for her, till when we forecast she'll need this protection. I mean, just take the assisted living. I mean, you could see right here, it's 183,000 per year, 732 total if her long-term care event lasts 4 years. So it's to get any kind of leverage in return is essential because the cost of care can be staggering. I mean, what would this paying for this out of assets do to the assets under management? It would devastate them. And oh, by the way we designed it in this case is in all of cases, there's liquidity features. What do I mean by that? Well, if Miss Jones wants to change her mind and just get all her money back, she can. There's liquidity features. There's ROP, there's cash value. If she doesn't need the long-term care and she, let's say, dies peacefully in her sleep without ever needing long-term care, her family will get that $100,000 back. There's a built-in death benefit. So in this case, we maximized leverage for long-term care, gave Brenda the ability to change her mind on that $100,000 contribution. And by the way, if she didn't need it, her family would get that money back. So what did the math tell us? This is the correct math. It told us that self-funding costs more than pooling your risk with other people, de-risking your portfolio, and that there's flexibility involved. Thank you to those liquidity features that you could change your mind, or if you don't need the long-term care, it passes to your family. So this is the correct math. We send this one-pager out with every quote to aid our advisors and their clients in making this very important decision. So here's your call to action. Does the math favor de-risking the portfolio? If it does, show it to your client. And I would challenge each of you that use wealth planning software to create a scenario with a long-term care event, let's say at age 82, and then create another without long-term care protection, and then meaning long-term care insurance, and then using that same long-term care event, include long-term care insurance, asset-based long-term care insurance. What happens to the plan? What happens to the assets under management? It is not a question of whether or not my clients can afford it. It is a question of what is the best use of their wealth. And then put it in front of the client and let them decide. Please reach out to us with any questions you might have regarding long-term care. We'd be more than happy to assist you with that. Thank you very much for your business. Have a great day.